My favorite question in the stock market is, why is it going up? Why is it going down? Well, let's talk about why it's going down today and see if we can make sense of some of the craziness. If you're watching the stock market, you're going, oh, this is a little wild. And you're right. But let's talk about why that is and what we need to be looking for. Hi, everybody. Jared Johnson here. Let's dive right into the charts and see if we can, in just a couple of minutes, make sense of what is happening in the stock market. Okay, let's look at a couple of charts here. Here is our VIX. Remember, we've talked about the VIX plenty of times. Danger zone is up above here. We're still not there, although the VIX has spiked up a lot today, and we got to keep an eye on that because that's a little bit of a warning sign. But what we really want to look at, here's something very important to remember in the stock market. It is a future valuation machine. If the stock market feels like it has a pretty solid idea of what is happening over the next, 4 to 6 months, things are pretty stable. If it does not feel like it has a solid grasp of what might be happening over the next 4 to 6 months, things go a little bit crazy. Now, the current administration is making a lot of economic changes and it's shaking a lot of things up, but the one thing that is driving the stock market nuts is the lack of certainty. President Trump, he's a little bit of a wild card, and so there's a lot of uncertainty there, and stock markets hate uncertainty. That's what kills markets. Now, it gives us an opportunity to be buying into some dips, which I always like. I'm forever bullish the stock market, but we don't want to get bullish too terribly soon, and let's look at a couple of reasons why. Peek at this chart with me for just a moment here. And what we see here is, let's just expand that screen just a little bit. This is year-to-date performance of all the different sectors. Now, this might seem like a bunch of charts and a bunch of jumbled stuff, but just work with me for a moment here. On this chart, we can see, let's just go that way just a hair, we can see that the worst performers are these guys right down here. We've got, we have consumer discretionary, right? This is people buying, this is retail. This is people buying stuff on a daily basis. That's down. This is year to date, down 13%. What's the next one? XLK. This is tech. So retail and tech are just getting hammered because everyone's worried about a recession. They're worried about running out of money, worried about all that. So those are the worst performers. And what are the best performers year to date? XLE. That is energy, right? So do you need Lululemon clothes? No, you do not. Although that's arguable by some metrics. Do you need to buy a bunch of heavy tech stuff? Probably not. Do you need, hold on here, my chart's getting all messed up. Do you need energy? Do you need gas for your car? Do you need gas for your house? Do you need those types of things? Absolutely. XLV, healthcare. Do you need healthcare? Of course we do. And the next top performer, XLU, utilities. So these are kind of bad signs for the short term. This is saying that the market is going very defensive. They're saying, hey, the three things that you have to have, healthcare, energy, and utilities. If the market falls into complete despair and destruction, you're going to have to be able to flip that switch at home and the lights go on, right? So this is a very defensive outlook that the market's having right now. Energy, utilities, healthcare. And the things that are less important, tech, consumer spending, way down. So this is telling us, don't listen to the news, don't listen to CNBC, don't listen to anything. The news is from the charts, and the charts are telling us the market's a little scared right now, and it doesn't know what to do. It thinks that it needs to go into a defensive positioning, which is exactly what we're seeing right here. So that being the case, we go back over here to the charts and we look at some of our basics. Remember the things we've talked about, the VIX. This is our fear index. Now, it was up a little bit today. It's coming back down. Fear is calming. It's stabilizing just a little bit here. But still, doesn't change the fact that if you look at kind of today's markets, right? And we just do a little bit of this and we say S&P, Russell, NASDAQ, right? We look at those three. That still tells us a little bit of pain, right? The NASDAQ's down 1.25%. The Russell's down about 1%. The S&P's down about 0.5%. So there's still some fear out there, but this is not the death blow to the market. This is just the market is positioning itself because it doesn't really know what to expect right now. If we look at the S&P, the SPY, we can see that, remember, when you see a dip like this, 10%, that tells us that's corrective territory. But when we see a move beyond 10%, which this still is in the 10% range, we had a low of 10.9, 10.93%. We still haven't achieved an 11% sell-off, and maybe my numbers are just a little bit off here. We're kind of 10.8, 10.9%. Getting a little bit of a bounce here. It's the end of the month. Last trading day of the month. We sometimes get a little bounce there, but this is looking a little bearish on us. When we see the market positioning like it is, where we have all the utilities and energy, the safe things that people have to have going up, and consumer discretionary and those things going down, this tells us that we have a higher likelihood than not that we might see a little bit more of a correction. We might see this thing go down into maybe the 15-ish% range, which I wouldn't be surprised to see happen. That takes the S&P down into kind of the lower 5,000s, the S&P or the SPY into the lower 500s. So we might see a little bit more of that, just because, remember, the market is not feeling very confident about what it can predict over the next 4 to 6 months. As soon as it finds footing there, I think we see a quick turnaround. But until it does, the odds are probably leaning a little bit more towards we see a 15% dip in the S&P versus the solid 10. But we have to get beyond 10%, and that's this low right here, and so far it hasn't been able to. So things are still looking a little bit, they're leaning on the bearish side, but we could very much see a bullish surprise here. But these are just kind of the areas to watch for. Remember, the market is not totally panicked about the economics of everything. It's panicked about it doesn't know what to expect. If it knows to expect something bad, great. Then we see that. If it knows to expect something good, we'll see that in the market. But right now it doesn't know what to expect, so it defaults to fear, selling, get out, take profit. Thanks, everybody. Have a wonderful week, and let's hang in there. It's going to be a wild ride, but this will create some very excellent opportunities for sure. Take care, everybody.